Well, Jerry, thank you so much for being here.
Absolutely. Thanks for having me. I'm really excited.
I really do appreciate it.
Yeah.
So for our listeners, we've met a couple of weeks ago.
We did.
It was at a Mortgage 101 CE class. I was getting some continued education hours.
Yep.
And I must say that I was just impressed. I felt very engaged. There was a lot of great information. I found it to be very insightful and useful. Again, engaging a lot of the continued education classes are not so interactive.
Sure. Sure.
And so I thought that this, especially in the current climate with the industry, there would be a great time to have a conversation, and hopefully our listeners can gain some of that same value.
Yeah, I love it. I always say to whether it's realtors or clients, and I've been doing this for about 20 years, but what I tell them all the time is that I do this all day, every day, you don't, right? And so I'm not expecting other people to be experts and masters in the mortgage world, because that's what a mortgage loan officer is supposed to be.
Right.
So when I do a CE class or when I talk to clients and borrowers, I think it's really important to give them information that they need, not to just drown them in information that isn't necessary. So I'm glad to hear that you got a lot out of that class.
Yeah. Well, thank you. Yeah. So I guess where we could start, what is a mortgage loan officer?
So a mortgage loan officer there are a couple different ones, right? So there's a mortgage loan officer at a bank. If you work at a bank, you don't have to be licensed. You just have to be a registered loan officer. If you work at an independent mortgage bank, such as myself at Silverton Mortgage, you have to be licensed. You have to pass a test. You have to do continuing education. It really is a very highly regulated industry. And so a mortgage loan officer is the person that is going to put you in a position to get your mortgage, your loan to buy a house. They should be the financial expert that you can rely upon as a client for them to put you in a proper position. So they're really the ones that are going to work to get you the money that you need in order to buy the home.
Oh, very nice.
Yeah.
So what inspired you to get into the industry?
So a buddy of mine that I used to work with, I was originally a stockbroker, and you just pounded the phones all day. I used to make 700 dials a day. Now, again, keep in mind, this was 20 years ago, and so the internet wasn't what the internet was, and so there was no social media. So you had to reach out and you had to call people to try to get clients, and it was backbreaking. Yeah. And then not only was it backbreaking, but really in a lot of sense, you were at the mercy of the market. And I would come home in a really bad mood, and my wife, who's my wife now, at the time, part of the time she was my wife, part of the time she was my fiance, and she would just say, Jerry, you have to figure out a way to leave this at the office. You can't bring this home with you. And I had a buddy that left where I worked as a stockbroker. He became a mortgage guy. And we sat around one night over a couple drinks, and he told me all about it. And I thought to myself, you know what? How much less stress is it going to be for me to actually give people money as opposed to take it away from them? So this was my impetus to get into the business. Little did I know that this had its stress of its own that comes along with the mortgage job. But that's really what did it, was more about not reaching out and asking people for money and try to invest it for them, but it was more about trying to get them the money that they needed to make their dreams come true. And that's really what motivated me to make the switch.
Oh, very nice.
Yeah.
Yeah, I think a lot of people are hearing 700 dials a day.
Yeah.
And their KPIs now are like 100 or maybe 200 a week.
Yeah.
And nobody cold calls anymore or whatnot.
It's a different animal, and it was a different time. You had to do it back then. And it was funny because I used to call something called Dun and Bradstreet leads, which nobody knows what they are anymore, but you used to be able to buy leads of businesses and successful business people. And some of the calls that I got to make were great. Got to speak to Spike Lee one time on the telephone. So even with as difficult as it was, there was always kind of that carrot hanging out there that made you continue dialing.
Sure. No, for sure. I think some of that is missed today.
Yeah, I think so too.
I find some value doing that myself too, just by, you never know what somebody's going to say. The worst they can say is no.
That's it.
Or maybe not respond at all. And that's kind of how this happened. Hey, you reach out, you put yourself out there, and maybe that works that way.
Yeah.
So I appreciate that.
Yeah.
So typical day to day as a mortgage loan officer. I know now you're much more of a management role.
Yeah. So I'm a regional sales manager for Silverton Mortgage, but I was a loan officer for a long time. I've closed a lot of loans. And day to day was really contacting people. It was contacting realtors to try to make them a referral partner with you. And really part of the key to that was just to explain to them what makes one loan officer different than the other. And I think we talked about this in the CE class. You know, there's some loan officers out there, mortgage loan officers, that'll type a bunch of information into a computer, and whatever spits out, that's the recommendation that they make to the client. Then there's what I like to refer to as a mortgage professional. And there's somebody that looks at the mortgage transaction as a financial transaction. And we dig a little bit deeper into what the client is trying to achieve short and long term, as opposed to just getting them the money to buy the house. So a lot of what we do during the day is going out and trying to get business, establish new relationships. But education is a big part of it as well, not only from the mortgage side, but just from the economic side of things, to understand what drives mortgage interest rates and what drives the housing market.
Gotcha. And if we can touch on that a little bit, the current state of the market.
Yeah.
What are your current insights, or what are your thoughts on the current market?
The rate market that we're
Yes,
speaking of?
yes.
So, listen, I think all of us have seen the meme on social media, marry the house, date the rate, right? I mean, if we just look at the basis of what that means, it means, buy a home, live in the home, and the rate is fungible. You can get an interest rate of 6.25% today. Doesn't mean that a year and a half now you can't refinance into a loan at, God willing, 5.5%, 5.5%, 4.75%, if they come down wherever they end up coming down to. But what I like to tell people all the time is, don't worry about the interest rate, okay? Worry about the monthly payment. The monthly payment is directly affected by the interest rate. The higher the rate, the higher the payment. The lower the rate, the lower the payment. Concentrate on whether that payment fits within your budget, whether you're willing to maybe expand your budget a little bit by cutting some other things out of it to get into the house that you really want. And then if you get an opportunity to refinance, you refinance. But I don't like doing refinances just to save on the monthly payment. I think that going into it, if you can handle the payment, stick with the payment. So when you do a refinance, my recommendation would be, look to get into a shorter term mortgage, go from a 30-year to a 20-year, or a 20-year to a 15-year. That's one way to benefit it. And then the other way to do it as well is, even if you lower your monthly payment, keep that difference and put it into an investment or a high yield savings account. So again, you're keeping your monthly payment the same, but you've put yourself in a much more advantageous position when it comes to your finances if you handle the mortgage as a financial tool, as opposed to just, oh, good, I saved $200 a month, I can go out to dinner twice more a month.
Right. And on that note, I think of debt to income ratio.
Yeah.
Now, what are some things that go into debt to income and things that do not, like my phone bill, things like that?
Yeah, so debt to income ratio is one of the main things that we look at to approve a mortgage, okay? Something really important in the mortgage industry that came out of 2010 and some of the changes was something called the ability to repay. And so we look at the borrower's ability to repay, and a big part of that is the debt to income ratio. What the debt to income ratio is your income coming in each month, your gross income, meaning before taxes, before 401, before health insurance. It's what your actual salary is, and that's versus your monthly credit bills. So whatever is going to show up on your credit report, minimum monthly payments on your credit card, furniture installment loans, student loans, car payments, any other mortgages that you may have, we take the total of that along with the new mortgage, we divide it by your gross monthly income, and that gives you your debt to income ratio. And the allowable debt to income ratio, depending on the mortgage product, is anywhere from about 43% up to about 55% of your gross income that you're allowed to spend on all credit bills, including the new mortgage.
Gotcha. Now, you mentioned 2010 and regulations there.
Yeah.
So I don't know about you. I hear a lot of, oh my gosh, the market's going to crash again. It's going to be another 2008 or 9. And I think there's a disconnect. There were some regulations that were put into place post, that scenario that will hopefully prevent us from those things happening again. And one of the things you mentioned was ability to repay.
Correct.
Were there some other things, or what were some of the other?
Look, it was the Wild West.
Right.
I mean, I've been in this business since 2004, and really the window of about 2006 to 2009 is where everything just went crazy. So back in the day, I used to be a mortgage broker, not a mortgage lender. And so what that means is I would put the file together. I'd be the middleman between whoever was lending the money and the client, okay? It got so crazy during those years. I used to broker to one of the bigger banks here in Atlanta. I'm not going to say their name. And if the client had a credit score of 700 or above, I would turn in the full package, and, you know, pay stubs and bank statements and W-2s and the whole thing, and I'd work my butt off to put this whole thing together. And if the client had over a 700 score, my rep from the bank would come drop it on the table and say, I don't need any of this.
Right.
You know what I mean? We'll just say what the income is. We'll just say what the assets are. And consequently, you would have clients that, and I don't want this to come out as me belittling anybody, because I'm not, but we would have clients literally that would work at a fast food restaurant flipping burgers, and they would be able to come in and say that they were making $20,000 a month. So those people that stated that they made $20,000 a month couldn't handle this mortgage payment. Thus, we would have known, or should have known, they did not have the ability to repay. And it's things along those lines that really caused the problem in the market, in the mortgage market, which of course led then to the problems in the housing market. Right. So in 2010, the Fed stepped in, they created something called the Dodd-Frank bill, and that changed the industry completely. All the rules of ability to repay and all these different things came into play. And it also forced the mortgage loan officer to now start getting licensed, as I mentioned before, and has made it a very highly regulated financial position where I think prior to 2010 and prior to all of these requirements, I think that mortgage people were really looked more at you as used car salesmen than they were as financial professionals. So a lot has changed since 2010.
Interesting. Yeah, no, that's good insight. Now, another thing to touch on in terms of interest rate and history, you hear a lot now is, oh, they're higher than they've ever been. Affordability is the lowest that it's ever been.
Right.
But there is a historical number. We've been average around that 8, if I'm not mistaken.
Yeah.
When someone mentions to you affordability is so low or interest rates are so high, what's your typical response?
Again, my response is don't focus on the interest rate. Focus on the monthly payment. And, look, I mean, there are some people that, are very financially savvy, and they're going to sit down and they're going to run the numbers, and they're going to look at the interest over the 30 years of the loan. They're going to look at tax deductibility, whether the interest rate allows them to itemize or if they're just going to be under the standard deduction. There are some very financially savvy people out there, and they're going to look at it from top to bottom. But the majority of people are buying a home. Okay, they're going to look if they can afford the monthly payment. And that's really what this whole thing should boil down to. The interest rate is the interest rate. You're borrowing money, okay?
Right.
And I'll tell you this much right now. You're borrowing it at 6.25%, 6.5%, or whatever. Your credit card is charging you 29% interest. What do you think's the better investment, right?
Yeah. I did in-home sales. It was in-home, one call close, home improvements. And we did offer financing options, and our best rate would be 9%.
Right.
And it's funny that you mention, well, you are loaning money, because people would, if it's seemingly forget that. It's like, well, you don't have it, you're asking for it, and there is a cost to borrow somebody else's money. And so I always had a lot of fun with that. But that taught me a lot about it always coming down. It should be about monthly payment.
It should be.
Affordability. Not the number.
Right.
And then on terms of that, there's also things like prepayment penalties or no prepayment penalties. With the standard mortgage, one of the main myths is that you can't pay it off early. You're locked in for 15, 20, 30 years, whatever the case may be. Is that true?
So again, in 2010, a lot of the rules were changed. And to do a regular standard conforming mortgage, there is not allowed to be a prepayment penalty on it. The only time that there's a prepayment penalty on a mortgage is if it's a real niche-y product. We call them non-QM. And what QM stands for is qualified mortgage. So in order for it to be a qualified mortgage, a conventional loan, FHA, VA, USDA, any of the standard loan products, it cannot have a prepayment penalty on it. So once you get into the niche market and you do a bank statement loan, meaning you're self-employed and you can't show tax returns because nobody wants to pay the IRS and you write off everything you can possibly write off.
Right.
So we qualify you using bank statements. That's going to be a higher interest rate, but that also will be allowed to have a prepayment penalty because it's a mortgage product that's outside of the norm.
And speaking of mortgage products, another myth is that no matter what, I have to have 20% down in order to buy a home.
Right.
Would you talk a little bit about that? Is that a myth?
Yeah, that's a myth. I mean, it used to be the case back, I think, in 1980 when my parents bought their first house. And by the way, on that house, they paid 17% interest on it and had to do more than a 20% down payment.
And they tell you all the time.
Oh, did they tell me all the time?
They-
Because when I bought my first home, I think it was in 1995 or 96, my interest rate was 8.5%, and I was howling, and my parents were like, that's half of what we paid.
Right.
So back then, yeah, I mean, getting a mortgage was a whole different ball game, and that's a story for another day. There was no aftermarket to sell the mortgages into and so forth and so on. But nowadays, no, there's no requirement on down payment. There's a ton of 100% financing programs out there. There are first and second mortgages that you can do that can limit the amount that you need. The one key on a conventional loan, so there's conventional loans, and then there's what's called government loans. Government is the FHA, the VA, and the USDA, and those are backed by certain entities within the federal government. The conventional loan is not backed by the federal government. But even on those, there are a lot of programs where you can do 100% financing on those. There are a lot of those programs where you can do very minimal down payments, and you're actually rewarded on some of those down payments with better interest rates and better private mortgage insurance if you make under a certain amount of money. So in today's market, in today's housing climate and environment, the federal government really is pushing for home ownership for people that have not been able to qualify before, and that comes with lower down payment options.
Gotcha. What are some of the common challenges that you're seeing for first-time home buyers, or maybe just home buyers in general?
Debt.
Yeah.
Debt. I mean, look, I'm not Dave Ramsey. I'm not going to sit here and preach that you should have zero debt whatsoever. I do believe there is some good debt. I think a mortgage is a good debt in a certain sense. I mean, obviously you love to own the home outright and you'll get there eventually, but there is some good debt. But people we've gotten back into a position since COVID. During COVID, everybody qualified for a mortgage because nobody had any debt and interest rates were rock bottom, and that's because the economy was about to collapse, right? People couldn't go out, they couldn't go to restaurants, they couldn't go to movies, everybody was just saving money. That is completely flipped around, and there is so much debt out there right now that really is what's stopping people from buying homes. It's debt that I'm not even used to seeing, right? Like, it used to be earlier in my career when you saw student loan debt, if you saw 30 or 40 grand, it was shocking. Now you're not shocked when you see student loan debt in the six-figure range. When I used to see a car payment of $500, I used to say, my God, this person is insane.
Now that same guy paying, it's $1,200.
$1,300 is not uncommon to see a car payment or whatever. This is why you got to get your financing lined up and get pre-approved before you go buy a mortgage, because those monthly debts will absolutely crush you when it's time to go buy a home.
Yeah. I could not agree more. What's the difference between a pre-qualification and a pre-approval?
Depends who you talk to. I'll give you my definition of them. Pre-qualification is a conversation with a borrower on the phone, believing everything they say with no supporting documentation, running some numbers, and putting your name on a letter and says you're good to go to buy this home. That tends to cause a lot of problems later on down the road. A pre-approval takes it a step further. We get a full loan application. You get income and asset documents to support what they have in their application. We get a credit report, and then we run it all through the system to make sure that the deal works. And that, as a realtor, as a borrower, you can have a whole lot more comfort level if that mortgage loan officer takes the extra steps at the very beginning. Look, I know this is a lot of paperwork. I always say about a mortgage, they're simple but not easy. And what I mean by that is I can explain to you exactly how everything works, and I can explain it in terms that you're going to understand. Simple. But what's not easy is documenting everything.
Right.
That's where the issue comes into play. And so a lot of realtors, a lot of home buyers, and a lot of mortgage people want to make it easy up front so that the buyer doesn't get scared away. But what ends up happening is later on the surprises pop up and everybody gets into trouble, whether it's the buyer, the seller, the realtor, the mortgage loan officer. I prefer to see a mortgage professional do the heavy lifting up front, make sure that we've got a solid buyer for the house that they're going to buy, and then it makes the process easier as it gets all the way to the closing table.
Yeah. No, I love that. What I think of when I hear that is address the elephant in the room, and it's not the same idea, but you get out ahead of it, do what's uncomfortable on the front end because you've learned from the mistakes and the risk of not doing that.
Right.
And a lot of people, as a sales manager, I know you've seen it, I've managed quite a few and large sales teams as well, but not to the extent, but seeing those bad habits as well because you're afraid of the rejection or objection rather than just getting out in front of it. And I just think, hey, address the elephant in the room. Let's have an honest conversation. Let's do things the right way.
Yeah, I mean, I've told clients for years up front, think of me as the gatekeeper. I'm not the IRS. Just tell me what the story is. Let me know everything so that there are no surprises later on down the road. And if it's going to cause you a problem, I'm going to tell you it's going to cause you a problem. And then we're going to work on a plan together to fix the problem before you even start looking for a house. Because I've seen it happen a million times. The worst thing that can possibly happen, because this is a very emotional transaction as well as a financial one, is people go, they find the house of their dreams, they get into a bidding war, they finally have their offer accepted, and then halfway through we find out that it can't be done because something pops up. Just tell me up front and I'll let you know if it's going to be a problem or not. Don't hide anything from me, because by hiding it from me, you're causing yourself to have risk later on in the transaction.
That's right.
Yeah.
Now, you mentioned credit card debt previously, and I don't want to get too far off of that. What I hear a lot of, and it's something that's very common, I know you hear it a lot too, thoughts on balance transfers. We have a lot of credit card debts that are, say somebody has a credit card with a $15,000 limit and it's at 12. Is that better, or is it the same, or how is that different than, say, having 4 credit cards that have a max of 15 that are only at, say, 3?
Yeah. So it depends what you're trying to achieve, right? I mean, if the goal is to not worry about your credit score, but to pay as little interest as possible, then yeah, move all the balances over to a zero balance card and pay it off before the accrued interest hits a year, 2 years, 3 years down the road. But if you're concerned about your credit score, here's the issue that you have, okay? One of the big things on credit reports and credit scores is referred to as credit usage, okay? And I'm talking about revolving accounts. What revolving accounts are credit accounts that you can charge up and you can pay down, and you can charge up and you can pay down. When you pay it off, they don't close it. An installment loan, like let's say a car loan, you got 5 years worth of payments. It's the same payment every single month. And then at the end of it, they close the account and you own the car. I'm not referencing those. I'm referencing revolving accounts, credit cards, home equity lines of credit. Again, things that you can charge up, pay down, charge up and pay down. From your high credit limit in your scenario that you're talking about with a $15,000 credit limit, you really should not be above 30% usage on that, which would be $4,500 in your situation, okay?
Right.
Anything below a $4,500 balance or 30% of the high credit limit is generally considered to be good for your credit. Anything above that is considered to be bad for your credit, okay? Now, if you were to take all of those credit cards, let's say you had 3,000 on the 4 of them, and they all had a $15,000 limit, right now you're looking really good. You move all that money over to one credit card, okay, which would be $12,000 on a $15,000 limit. You now have a 75% usage of your credit limit, and that is going to kill your credit score. So again, like most things, it all depends on what you're trying to achieve. And if you're trying to achieve paying off this credit card as quickly as possible and not getting charged interest, by all means, move it over to the zero interest balance transfer one. But if you're trying to keep your credit score high to be able to qualify for a mortgage, do not combine those.
Yeah, that's my thought. I'm thinking of, I'm a listener right now who's, maybe a college student or just getting out of college who has okay credit but has high credit card debt. They've been a college student and whatnot. That coming from that perspective.
Yeah, I mean, again, it's, they'll tell you, people will tell you that don't really know and that haven't been doing this for a long time, that they'll take all of those credit limits, the 60,000 in your scenario,
right,
and they'll add all that together and then all of your debt and add it together, and it should be less than 30% of the total. Not from what I've seen in my years in this business. They will crush you if you move all of that to one credit card.
And high risk, because depending on what the agreement is, but 18 months, no interest, or 24, whatever. If you don't pay that in full, a lot of people don't realize that all hits all at once.
It
I hear
accrues,
those horror stories all the time.
Oh yeah, absolutely. I mean, if you're going to do, and listen, I'm no credit expert.
Sure,
right?
so
but if you're going to do a balance transfer, it's got to be to the goal of paying that thing off within the amount of time that you have that 0% interest rate. That's got to be the goal, or else why would you do it?
Yeah. Now, for me, I hear a lot of, why don't I go with a big box retailer like, so-and-so that you see on a
bank
billboard.
you're talking about?
No, for me. No, I just mean me as a realtor.
Okay.
Sorry. So like Mark Spain.
I got you.
I get asked, I see these commercials. Why don't I just go with Mark Spain?
Right.
Now, I think I have an answer for the question I would ask you, because I've dealt with this myself, but for others to hear, why wouldn't I just go with somebody like Rocket Mortgage?
Yeah, so I think it's multi-layered.
And
right?
I can edit out the rocket part.
Yeah. I mean, I think it's multi-layered. First of all, before anything else, is most realtors have a comfort level working with a local mortgage lender.
Right.
And listen, we're still in a pretty tight real estate market. I mean, there's some areas of Georgia that have opened up a little bit. There are other states that have opened up a little bit. But in and around Atlanta and the northern suburbs, it's still a tight market. Mm-hmm. And you're probably going to be making an offer on a home that other people are going to be making on an offer as well. And you really want to set yourself up for success. So besides being fully pre-approved for a loan, working with a local lender will give the listing agent, the person that's selling the house, more of a comfort level about getting the mortgage done and getting it done on time. When you're dealing with one of those big companies, things tend to get lost in the wash, right? It's just kind of one of those deals. Now, look, this is all a numbers game, and you're either approvable for a mortgage or you're not approvable for a mortgage. There's no real middle ground there, right? So, if you have an 800 credit score and your debt to income ratio is well below the thresholds that we talked about before, from you as a client, the perspective, there's nothing wrong with going to a Rocket Mortgage. There really isn't. But in a tight real estate market, you want to give yourself every advantage that you can, and working with a local lender is going to be the bigger advantage. And I think the other part of it, again, is what I was talking about before, is a lot of those guys, and I'm not knocking them, but most of them are what I refer to as order takers. The phone rings. They don't have to earn the business from a referral partner.
That's right.
So they take the call, they type into the computer what your financials are, and the computer says, offer them this. And that's what they offer it. When you work with a local lender, we don't do a lot of national advertising during the Super Bowl, and, everything's not named after us. Falcon Stadium is not the Silverton Mortgage Dome, and all this different stuff. So we have to earn that business, and we're not order takers. So consequently, we have to live up to our commitments that we're making to everybody involved in the transaction. And then going back to what I was saying earlier, we've got to look at this from every direction to make sure that we're putting you in the best loan program for you, not for me.
Yeah, I think the local thing, my experience has been with I call it big box. It's just your client, you're getting passed around.
Yeah.
From one phase, each person's got their job at the call center or whatever the case may be, and once they finish with the pre-qual or pre-approval, then you're switched over to somebody else, and then somebody else, and somebody else. And as there's times where, hey, I might need to, or my client may need to speak to a lender at 8:30 on a Sunday, or whatever the case may be, and I've seen one too many times where that just hasn't been the case. And I'm sure there a lot of people have an amazing experience with them. There's a reason why they're on, named after, there's buildings that there's arenas and commercials and whatnot.
Sure.
But I think that I think it's still important. People don't go into the office as much anymore. You're not coming in to talk directly to your loan officer. You're not coming into Atlantic Communities to meet with the realtor. You're but there still needs to be that human local element and where you can build a relationship with somebody.
Yeah, there does. And, remember too, ultimately all of this is a business. Nobody's in this to lose money, right? Everybody is in this to make money, or else we wouldn't be doing it. Nobody would. The realtor wouldn't, the mortgage loan officer wouldn't. So you got to look at what the core business is of who you're dealing with, okay? So for example, the big banks, the Bank of Americas of the world, the Wells Fargos of the world, or whatever, they're not in the mortgage business. They're in the asset accumulation business, okay? They want your checking account. They want your savings account. They want your investment portfolio. So they use mortgages as a loss leader. They want to hook you. And like one of the big banks, for example, I was talking to a client the other day, and they told them flat out, if you move your savings account over here, we'll give you a 1/4 point lower rate in the mortgage, okay? Wow. Great deal. But if it's a loss leader for them, if that's not what their actual business is, which is accumulating assets, how good are they at doing mortgages? Where at Silverton Mortgage, all we do is mortgages. So we have to be good at it. There is no loss leader for us. You know what I mean? We can't take a loss on mortgages to make money at a different part of the company because there isn't a different part of the company. So we have to be good at what we do. And then the online lenders, the Rockets of the world, the Better Mortgages of the world, and things along those lines, they're at the mercy of their shareholders. Those are huge, huge companies that trade on the New York Stock Exchange, the NASDAQ. And so the profits don't go to their employees and it doesn't go to the owner of the company. It goes to the shareholders. So once again, they're working towards the bottom line, where your local lender, for the most part, is working towards the client's best interest because we need repeat business to keep making our living. Does that make sense?
Makes perfect sense.
Okay.
Yeah, no, I appreciate it.
Yeah.
Can you tell me about a challenging time where you had a client or who has struggling to get approved and maybe they had been rejected, or maybe the programs that they were being offered by a couple of other folks just didn't compare to you guys and you all were able to get the job done?
Yeah, I mean, listen, again, a mortgage is either doable or it's not doable, right? And you can, what do they say? There's 20 ways to skin a cat. So again, that's why I lean on that it's so important to deal with all of this different stuff in the beginning, okay? Because if we do find a problem, if your debt to income ratio is too high, if your credit score is too low, if you don't have enough assets, let's work on it. Let us give you the advice of what you need to do in order to do that. And then let's talk once a month, once every 2 weeks to see if you've done everything that we've told you to do to put you in a position to do a mortgage. You're not going to get that from the big banks, and you're not going to get that from the online lenders. So we don't really run into that a lot in the mortgage banker space because most independent mortgage companies like Silverton are doing a lot of that up front to make sure that we don't have any problems. But there are some niche things, we have a loan. I mentioned the bank statement loan before for self-employed borrowers. We also have a 1099 loan, okay? For 1099 borrowers, once again, you're going to be a Schedule C on your tax return. You're going to write off as much as you possibly can against that income. And a lot of mortgage companies are just going to look at it. They're going to take the deductions out. They're going to say you don't make enough to qualify. And I had that happen to me a couple months ago. The borrower came and I said, all right, well, let's look at this 1099 loan, okay? And we took the average of the past 2 years 1099s. We take 10% off the top for expenses, and then the rest of the income is what we have to qualify you. So we ended up getting the borrower into the home. And my first conversation with the borrower was, look, I know none of us want to pay the IRS, but you're in a higher rate product because it's a niche product. So do me a favor on next year's tax returns, don't write off as much, pay the IRS, and then I'll have an opportunity to refinance you into a regular conforming loan that you can be into for the long term. And so that was one that we took from another lender because they weren't thinking outside the box in that regard. Perfect. You know what I mean?
Yeah. No, so we hit the all lenders are the same is a core myth that I kept kind of popping up on.
Yeah.
And you nipped that in the bud.
Yeah.
Another myth in mortgages or home loans, never get an adjustable rate mortgage. What is your thoughts on that?
So I'm not a fan of an adjustable rate mortgage because, again, what you're doing with an adjustable rate mortgage is you're getting into a home with a lower payment where the payment has an opportunity to go up on you, okay? So I'm not a fan of that because I'm fiscally conservative in my finances and what I recommend to the clients. I just know, in my mind at least, not know, I believe knowing what your payment is going to be every single month, and it's going to be exactly the same. Obviously, taxes and insurance can change. But knowing what your principal, interest, and payment is going to be, and never have to lose sleep because you know you can handle that payment, to me is worth not having the lower interest rate of adjustable rate mortgage. And let me explain, okay? People that did a 5-year adjustable mortgage 5 years ago in 2019, okay? An adjustable rate, an ARM or an adjustable rate mortgage, it stays fixed for a certain amount of time and then it begins to adjust on you. So in this case, a lot of people did what's called a 5-year ARM, meaning that the initial rate stays fixed for the first 5 years and then it can begin adjusting on you. All these people that did it in 2019 to save $75, $100 a month, or whatever it was, are sitting at a 2.5% interest rate, a 2.75% interest rate. We're in 2024 and all of those are about to adjust on them. Mm-hmm. And rates are considerably higher. Where are you going to refinance? You're going to refinance. If you go refinance, you're going to get the same rate that your adjusted rate would be in today's market. I like to look at something that I call the risk-reward ratio. How much am I risking, and what is the reward for the risk that I'm doing? Again, using the 2019 example, you maybe saved $75 to $100 a month. That was your reward, but what's your risk? Your risk is that your rate is going to be close to tripling now that you're out into the adjustment period. Just not worth it as far as I'm concerned. Now, I'm not saying that there aren't opportunities for that,
so
right?
What's the selling point? And who is that program designed for in your mind?
So,
or where have you seen it been utilized the most? Which client, which buyer does that typically fit?
Yeah, so really what that's really good for an adjustable rate mortgage is for somebody that has inconsistent income, okay? You may have a borrower that makes $50,000 a year in salary, okay? But makes $150,000 in commission, but you don't know that commission is going to be $150,000 every single year. It can waver a little bit, right? So I think that's the kind of person, or that gets big bonuses twice a year or something like that, because the adjustable rate mortgage will give you the lower monthly payment every single month, but then you're going to have enough savings from the different income, the commission, the bonus, or whatever, that you can put that away and cover yourself if the rate ends up jumping and going up.
Gotcha.
Somebody that has been with a company for 4.5 years and the company's standard policy at year 5 is to give a promotion, a healthy promotion. If you've been there for the first 5 years and you've done a good job or whatever, you know for a fact that you're about to start making more money, a year down the road. For somebody like that, it could make sense. But again, everything in the mortgage industry is based on risk, okay? So the more risky it is, the higher the interest rate is going to be. And remember what we talked about before, that we're still in this business to make money, right? On an adjustable rate mortgage, they're not going to offer you a lower rate than the fixed mortgage unless there's a payoff for them later on down the road. And so I think it's really important to put yourself in the mind of the people that run these banks. And remember, they're not doing any of this out of charity. They're doing this to make money. And if they're giving you a lower rate on a product that can adjust later on down the road, that means their actuaries are telling them that they're going to make money on that later on down the road. Just the nature of the beast.
Now, away from ARMs, do you mind giving a quick rundown of the most common? So we have FHA, conventional, we'll say VA and USDA. Just for the listeners who don't know, who are still convinced, I need 20% down, I got all this credit card debt, or whatever the case may be. Just what your core programs.
Conventional is, the pretty standard thing. There's programs where you can do 3% down, 5% down, 10% down, 20% down, more, right? That's the pretty standard thing. That's the small box that you have to fit into. You got to got pretty good credit, got to have pretty good debt to income ratio, got to have pretty good assets. That's the vanilla mortgage that everybody has known about for the last 30 years, 40 years in this country.
And that's the common misconception. In order to be approved for a conventional loan, I must have 20%.
Correct. And if you don't have 20%, there's something called PMI, private mortgage insurance, and that's basically paying the lender insurance in case you default on the loan. So it actually protects the lender, it doesn't protect you.
Right.
So the general thought process is if I'm going to go conventional, I'm going to put 20% down so I don't have to have that PMI, because once you have 20% equity, you either don't have to have PMI or it goes away if you had it before that. FHA is a Federal Housing Administration loan. It's backed by the federal government. And really that's in place for people that have lower credit scores and a higher debt to income ratio. It is more generous in what it'll allow you to do, and it can be because it's backed by the full faith of the United States government.
And often confused with first-time home buyers.
Correct. You don't have to be a first-time home buyer for FHA. I mean, it really just is a program that if you have a lower credit score and or a higher debt to income ratio and you don't qualify for conventional, generally you're going to get flipped into an FHA loan. And it's not a bad loan.
Right.
There are pros and cons to everything. And, talk to your mortgage loan officer about the pros and cons of each. But both of them are good products. It depends on your specific situation.
Right. And VA.
I mean, really, VA is the best loan out there. If you're a veteran or even a current service member, you deserve to be rewarded. You have served this country, and that's one of your rewards as a VA loan. It does not require a down payment. You can do 100% financing. It does not have PMI on it, even if you borrow 100% financing, and the rates are generally pretty good. You don't get killed with a low credit score. It's got a high debt to income ratio threshold. The only thing about a VA loan is there is something that's called a funding fee. Okay, and that's anywhere from 3%, 3.3% of the loan amount up, depending on how many times you've used your VA eligibility, and that gets rolled into the loan.
Right.
And that's kind of their PMI, but without you having to pay PMI monthly.
Right.
So that's the only negative about it. So that's why, I've run into borrowers that have a 10% down payment or a 20% down payment, and they want to go with a VA loan, and I tell them not to, because you're not really going to get hit very hard with PMI, but you still have to pay that funding fee. Unless you're a disabled veteran, then they waive that funding fee, and then that is the greatest loan like in the history of the world.
Right.
So that's kind of the difference. But if you don't want to do a down payment and you're a veteran or a current service member, go with a VA loan. I mean, it's just a fantastic loan.
Now, for FHA and VA, do they require that the home to be your primary residence?
Yes, on both of them. Now, once you leave that home, okay, in most situations, you're only allowed to have one VA loan and one FHA loan at any given time. But there are exceptions to that. With FHA, if you're moving more than 100 miles away from your current home, they understand the odds are is because you got a better job or you lost your job and you have to move for a new one, and they'll let you do another FHA loan if you're more than 100 miles away from your current property without selling it. And then VA's got some similar requirements. That goes back to how much eligibility you have left from the Veterans Administration on how much home you can buy. But once again, there has to be a reason that you're buying a second one. It can't be, I'm just tired of this home and I'm going to rent it out and I want to buy the one next door. Can't do that.
Right.
But if you're transferred, through the military, and you don't want to move your wife and your kids, there are a lot of exceptions to that. So technically speaking, you can only have one FHA or VA loan at a time, but there are exceptions to that, and you can only do it for a primary residence. Though when you depart a home with an FHA loan or a VA loan, you can make that a rental when you leave that house to go buy another one.
Right. Very cool. Well, I appreciate that. I think that's very important for folks to know.
Yeah.
So, as I guess before we wrap up here, and I really appreciate you coming out.
No, I appreciate you having me.
What's been the biggest change in the industry from when you started to now that you've noticed? Whether that's just whether you've seen that be your team, other anything. Not necessarily just with mortgages, but with anything.
Yeah, I think technology, I mean, listen, I'm sure every industry has been affected by this. The whether to the positive or the negative, that's your own call, the way that you look at it. But, like I mentioned before, we used to live on the telephone, and you don't live on the telephone anymore. I mean, I text now more than I imagined that I ever would. You know what I mean? Yeah. Because that's how a lot of people want to communicate nowadays, and I understand that. Along with that, I do think that a lot of mortgage people have become these mortgage professionals that I speak of, and are much more educated and in tuned with finances in general, not just lending money. So I think that's been a huge positive change for this industry, along with the licensing part. You can't have crappy credit and get a mortgage license. You can't have bankruptcies and judgments. And so they really want mortgage professionals nowadays to prove that they're financially stable in order to give financial advice to other people. And I think that's one of the best changes that we've seen in the industry.
Yeah, I love that.
Yeah.
No, that's great.
Yeah.
And in terms of where it's going, where do you see the biggest change in the next 10 years? I'm sure still tech.
Yeah.
But, and sorry, I mean to cut you off.
No problem.
But you see more automated underwriting systems, maybe appraisals going more towards, we have so much data nowadays with
Correct.
artificial intelligence.
Right.
Thoughts?
Yeah, that's it. Everything is data driven. And we're seeing now through Fannie Mae and through Freddie Mac, we're getting appraisal waivers where we don't have to have an appraisal because they have so much data of the neighborhood to be able to validate the value of the home. And so I think, first of all, I don't know if you're aware of this. I don't know if anybody is, but appraisers are one of the oldest industries that we have in this country, not by age of the industry, by age of the people that are in it. It is so hard to become an appraiser. You have to, for 2 or 3 years, you have to be an apprentice, and people aren't willing to put in that time to become an appraiser. So I think it's a combination of technology and need. As appraisers are starting to age out and retire and stuff, we're not going to have enough. And so, yeah, I think data is going to be huge, to whether it's the appraisal, to whether it's the ability to repay. We may start looking at things a little bit differently. And I think the ease of use, we have apps nowadays and websites and all this different stuff. I think that's going to continue as well. And I think the underwriting process, we're starting to see a little bit of it, but more and more of it's going to be automated, where Fannie and Freddie's automated system can simply say, you don't have to turn this into underwriting work. We're good with the loan. Go ahead and submit it as is. So I think we're going to see getting mortgages easier as a process, okay? But I think we're going to start seeing more and more people less qualified to buy a home because of debt, because of home prices. I think we're looking at a real contradictory future when it comes to home buying, mortgages, and all that stuff. I just don't see a lot in the economy and in personal finance right now that leads me to believe that we're on the path to get things better.
Yeah. Yeah, no, I like to think that next spring, or as you get into March, kind of April, rates have come down a little bit. They've gone down over the last month or so. And you'd like to think that you'd see more home buy or sales then, and you would have thought over the last couple of months that home sales would have picked up, but they really haven't.
Got to have somewhere to go. Yeah. That's the thing, right? We always forget when you're trying to buy a home, you forget that there's another side of the transaction because you're so focused on buying a home that you want to buy. A seller's not going to sell their house if they don't have a place to go. And that's the kind of the chain reaction of tight inventory. And remember, we went a good decade plus in this country without builders building homes, and we're paying the price for it now.
Yeah, and most of the homes that you're seeing built now are luxury homes.
Yeah.
So, tight inventory, it's been an issue. Okay, perfect. And let's say here, well, I'm trying to figure out how do we word it, but your current outlook on the housing market in 12 months from now?
Yeah, I mean,
your opinion or your thoughts?
Yeah, I mean, listen, I think some inventory will loosen up a little bit. I think lower rates will help because people will be a little bit more apt to sell their home if they have a current low rate. I think that we're going to see a lot more building coming up over the next decade of not the McMansions and not the luxury homes. I don't want to get into politics, but Vice President Harris is saying that she wants to put $60 billion into building affordable housing. Silverton Mortgage is owned by Clayton Homes. They're the largest manufactured housing dealer in the world, or builder in the world. If you haven't looked at manufactured housing lately, it has such a negative connotation. You know, people just think double wide and all this different stuff.
Trailer, they just think trailer.
It's amazing what they're doing with these products. And if you don't know the way manufactured housing works, they build it in pieces in a factory instead of building it on the land. And then they bring it from the factory on trucks in these huge pieces, and they put the homes together. They're beautiful, they're high quality. I don't know where housing's going to go, but I know what we need in order for housing to be right. And we need more inventive ways of building affordable housing for people. And I think manufactured housing will come into play. I don't love the government involved in my bedroom, but I do think that we need some pressure to build affordable housing, not just luxury homes. And I think the combination of those type of things, different housing products, barn dominiums, manufactured housing, all of this different stuff, along with a little, not a lot, a little government intervention. And I think that can ease the housing shortage, and that'll get us back to normality in the housing sector.
It's going to take some creativity.
It is going to.
Yeah.
It is.
Now, I'm a young mortgage loan officer. I'm considering getting into the business. What advice do you have for us?
It's like appraisers, the mortgage industry is full of kind of older people. The advice that I would give if you're young getting into this industry is attack it the way that you know how. And what I mean by that is I came into the business making 700 dials a day. It's not effective anymore nowadays. If you know social media, come into this business and lean on marketing and social media. Do what you're good at and talk to the people that speak the same language as you. When I say language, I don't mean English to English.
Sure.
I mean social media to social media. If you know that 100 of your friends are going to be looking for homes in the next 3 years, and you know that they're all tied to social media, go after that. Go after the business that you know that you're good at going to get, and make a career out of it.
I love that. That's great advice. Well, my last question for you, maybe put you on the spot. What is your why?
What is my why? So my why has changed. My initial why is money. You know, I was, married. We had no kids. We lived in a little townhome in Sandy Springs. And so, my initial why was money. And then as I started making more money, my why became moving higher up in the business and in the organization. And now that I've kind of gotten there, my why is community lending. I don't care what anybody says on the news. I don't care what anybody tells you, but generational wealth is built by owning real estate. The crazy statistic that I've seen out there, the craziest statistic, is a homeowner on average net worth is 44 times that of somebody that doesn't own a home. I don't care what anybody says. The quickest way to generational wealth is home ownership. And I can lend to people that make $300,000 a year all day, not sweat, and sit back in my chair and collect a paycheck. But I've gotten to the point in my life where I want to help people start building wealth that never thought that they could. And the funniest thing is I have a closing going on as we speak right now, okay, with a handyman. When he came to me, he was nowhere close to being able to buy a house. We worked on his credit. We worked on he's self-employed, worked on his income for over a year. He's closing today. He is the first homeowner in the history of his family. Nobody in his family, dating back 60, 70, 80, 90, 100 years, has ever owned a home. He is almost 60 years old, and he's the first person in his family to own a home. I promise you one thing, his kids will be the second homeowners because they'll see what dad was able to do. And that's my why right now, is getting people into homes and helping them advance their generational wealth.
Jerry, that's incredible. Thank you so much for
Absolutely.
sharing. How do we get in touch with you?
You can find us at silvertonmortgage.com on the web. My cell is 404-510-3469 if you want to give me a call, or look for us on social media because we're all over the place. We're the dinosaurs trying to figure out how to get younger too.
Right. Thank you, Jerry.
Yeah, man. I appreciate you having me out.
See you guys next time.
Take care.